Well, we are knee-deep in earnings season. Banks have had big beats, but two tech titans disappointing after the bell yesterday. Here for a closer look is Mike O'Rourke. He's the chief market strategist at BTIG, joining us from Philadelphia. And Mike, what do you make of the earnings so far in the CEO comments? Have we gotten any more visibility about where we are in the economy?
You know, Betty, I think we have. I think there were high expectations for this earnings season coming into it. And I think, broadly speaking, stocks, companies are living up to those expectations. I think we're seeing lots of examples of companies beating estimates for Q1 and then raising guidance throughout the balance of the year, but also not aggressively raising guidance. So I think they're still leaving some room for upside revisions later on.
Mike, we've got earnings, we've got Goldman, we've got Greece, it's John Erlichman. We have no shortage of stories out there, but I can count on one hand the number of times the S&P has moved more or less, or at least 1% in either direction. What's going on?
Yeah, it's interesting. I think we're seeing a recovery environment. People are buying into the recovery story. At the same time, you have an environment filled with liquidity. The Fed's very accommodative. It's funny. I'm a market bull, and I think the recovery is real and playing out nicely. But in the same respect, every time I hear Ben Bernanke talk, he sounds more dovish than I think he necessarily needs to be. I wouldn't expect the Fed to hike rates anytime soon, but I think that there could be a chance if we see job gains throughout the, as the year progresses, that the Fed should probably hike rates to 1%, the Fed funds rate to 1% before year end. But right now, the way the Fed's talking, it does not seem to be in the cards.
Hey, Michael, it's Adam Johnson. Betty tells me I'm always an optimist, but I got to be honest here. If you're talking about 30% earnings growth from last year to this year, and now all these companies are coming out, again, Amazon last night, not really upping guidance, is this thing getting kind of played out?
On some levels it is. I think, when you look at the 2011 earnings estimates, they're approaching about $94, $95 a share. I think that, the recovery should already be priced into those estimates, and they should not be coming up as rapidly as the 2010 estimates are coming up, because obviously we're seeing companies beat and the recovery's unfolding sooner. So I think there's some truth to that in certain scenarios, that you shouldn't expect companies to be raising guidance, that much going that far out, because there's still some worries out there.
Right.
There's still risk towards the end of the year.
But Mike, and by the way, you are an optimist. You are.
I appreciate that.
Okay, but Mike, it almost sounds like you were outlining before a scenario where you might see job gains in the economy, and you may even still see the stock markets go down because those fears come up of interest rate hikes. Is that the scenario we could find ourselves in?
I think the stock market has discounted a good deal of the recovery into the price action here. I mean, when you think about where we are, I was on a month ago, I said in a couple of months we could be above 1,200. We're above 1,200 now. I think people are realizing that the recovery is real. The problem I see going forward is we're starting to see people start to discount too much of the future, and you're seeing some stocks. There's definitely pockets of stocks and sectors that are inexpensive relative to historic norms, but you see other people embracing the consumer discretionary sector, and you see individual names getting expensive, and you see some behavior that makes you a little cautious,
right,
as we approach the end of the year.
Mike, in a word, the reaction from the market today to the durable goods data, which some would say looks half decent.
I think the market's still trying to find its feet based on the SVC Goldman story from last week, but the fact that we've recovered essentially back to the highs is a good sign. I think the market still is going to be. I would have thought we were going to push above to new highs had that SEC filing not come out.
Right.
Now at this point, I think the market still needs to do some work, and wants to slowly work its way higher without being too aggressive.
Okay. All right, Mike. Good to talk with you, Mike O'Rourke of BTIG.